Okay, perfect. We'll just give it a minute to start. Hope everyone is well and hope everyone is doing or making profits instead of losses. We just had the related retail sales was just released about 30 minutes ago, and the actual was higher than the expected, which is good for the currency. So the markets is having or actually is enjoying the news. What do you think? Is it enjoying or you're at a loss? Okay, I'm gonna start in a few. Just so you know, the questions will be answered in the end of the session. It's better to not have some issues going back and forth and looking at the chart and looking at your questions. So it's better if we keep it in the end. And hopefully, I'm going to answer all your questions. This session will be in English and I'll be presenting it. So I believe it's 4 o'clock. Okay. Okay, we should start. Bismillah ar-Rahman ar-Rahim. Good evening, everyone. Hope everyone's fine and doing great. Today, we're going to talk about the basics of online trading. Presenting first myself, this is Bedr speaking, financial analyst at CFI Kuwait. So before I get into the details of basics of online trading, the path, infrastructure, trading psychology, let me just give you a heads up. What are we getting into? We're going to understand what is CFDs, contract for difference, how to trade CFDs, under which brokerage you can trade CFDs, which I'm going to talk about CFI in particular. What do we provide and how can we benefit from this market? So in the beginning, why are you actually here? Why are you attending this webinar? Understanding this in general, it gives you freedom, or understanding this market gives you freedom by trading extra income. You have discipline by learning from your losses and waiting for the right moment to enter a trade. Risk-free testing, as you know, you can open a demo account and enjoy trading risk-free, understand how this market works and how to analyze and enter a trade at a specific moment with pre-analyzed data and strategies. Also, you can become your own boss. There is no issues in trading CFDs at any time, anywhere. You can do it at any time, anywhere, at the office, while traveling. You just need to have access to the internet, or even without access. Later on the slides, we're gonna talk about how you can put trades that are pending on a specific time frame or on a specific occasion or on a specific strategy. For example, you intend to trade at that specific moment and specific price. So going in and talking about CFI, we started in the 1998 as a private bank, and in 2005, we established CFI, Credit Financial Invest. And today, 2023, 2024, we're excited to tell you that CFI is worldwide available, MENA region. My entity, I'm talking to you from Kuwait, and I hope who's listening at the moment is, of course, from Kuwait and outside Kuwait. It's a pleasure to meet each and one of you. We have 25 plus award-winning provider, ultra competitive trading conditions, next generation access, dedicated supporting team, whatever you need, whatever help you need, assistant in opening an account, and some issues for trading analysis, trading experience, you can always reach out and we're happy to help. Advanced tools and analytics, free webinars, as you can see, and multiple platforms. We're going to get into that. I have major news regarding the multiple platforms that you're going to enjoy. So why trade in the financial markets in general? Now, as we know, despite the CFDs and despite contract for difference, in general, trading in the financial markets indeed gives you high returns, simplified business. You diverse your wealth instead of just waiting for your salary. You can invest in several places and have an income or an extra income or a side business from the financial markets. Going into the CFDs, the beauty of trading in CFDs is you can trade the opposite directions. You can enter a buy trade, you can enter a sell trade. That's the beauty of it. And we're going to get more into it, into the calculations and how can we interrupt and understand the meaning of entering a short position, which is selling position. Of course, you can trade it anywhere, anytime, be part of the global economy, higher ambition and form of fear of missing out. High returns, fitting in, trade anytime. These all are combined in the CFD markets. The timing is mostly 23 hours, 5 a week. So what do we provide in CFI, the instrument we provide? Here are the list of the instrument that CFI provides that you can trade in the opposite direction or in the regular direction, which is going long and buying position. You can always check back with your entity. What do they provide? I'm speaking from Kuwait. At the moment, we don't provide stocks. We will in the future, hopefully. So you can always go back to your agents, your account managers, and check with CFI in your entity. What do they provide and what services are pending at the moment at that specific entity? So the general idea of the CFDs, in the beginning, I told you what does CFDs mean, contract for difference. Here is a diagram to understand this particular meaning of the CFDs. You're the trader, you enter an agreement between you and the broker, which is, in our case, CFI. It's the general idea. It's not like a written agreement that you open a position and you write a written agreement and you submit it to the company. You know, it's the general idea. So you enter a trade by the agreement. It's either you're entering a selling position or a buying position. In the CFD language, we call it you enter short or you enter long. Long stands for you're entering a buying position, and short you're entering selling position. What do I mean by that? Wherever the price is, wherever it is, highs, lows, wherever it is, whenever you enter, you're basically entering at the zero price, let's say. For example, let me talk and simplify it. We're going to talk about the gold in general. So gold, for example, it's trading at 2000. You have a strategy you've made up, and you believe that gold is going to drop. Eventually, it's going to drop, and it's going to drop hard from 2000 to, let's say, example, 19,550, for example. I would enter a short position from that specific price. Whenever it drops, that's my profit. Now, calculating that profit and understanding the range that it drops and what do we call it in the CFD market, at a later stage, I'm going to talk about it, inshallah, in general. So the main idea from CFDs is you enter the general idea, enter an agreement between you and the broker. You can profit from the highs and the lows. As we said, you can enter a long position. So when it is in its lowest range, you enter a long, targeting the previous high. And when it's on the edge and it's the highest at the peak, you can enter a short position. So whenever it falls, you're benefiting from that fall and gaining profits from that specific trade. Flexible trading hours, gonna get to it at a later stage, low cost of participation, and wide range of products. So we got a brief idea regarding CFDs, how the market works, entering in both positions, buying and selling. One of the instruments is trading currencies or the FX pairs. How can we understand what does FX mean? What do the pairs represent? How do I trade the pairs? And what is it all about? What is major pairs, cross pairs, exotic pairs, and their definitions? First of all, FX stands for foreign exchange. Foreign exchange is you're exchanging a currency into another currency. We have an example here, Euro USD. For example, I'm willing to buy or to convert Euro into USD dollars. So I have the base and the quote. 1 euro is equivalent or equals or gives me in the conversion rate $1.16732. These numbers, of course, are used just for the example. They're not updated, so don't take it very strictly and seriously. So 1 euro is equivalent to, in this example, 1.16732. What does this specifically mean? It's I'm selling euro, in return, I'm buying dollar. That's the conversion rate. Now we have 3 pairs in the forex understanding. We have major pairs, cross pairs, exotic pairs. What do I mean by that? The major pairs are each currency that's against the US dollar. As we can see, Euro USD, Pound USD, Australian USD, USD Yen, and so on. The cross pairs are the currencies against each other, not against the dollar, US dollar. Exotic pairs are the currencies that have very, very limited trades or interactions, and usually the spreads, which I'm going to talk about later on, are high on the exotic pairs. There's no liquidity on the exotic pairs. Like there isn't anyone asking at a good price or anyone is bidding on a good price. So that's basically the exotic pairs. The range is very, very high between these two. Limited trades, or shall I say, limited quantity or limited liquidity for these exotic pairs. Now we have ask and the bid. Between these two, between the buyer and the seller, there is a spread. The spread is the commission of the company. It is the difference between the ask and the bid. As we can see here, the base on the example above, the base is 1.36298 and the quote is 1.36301. So that difference is we call it spread, which is the commission for the company. So it's basically on the screen. You can see it whenever you enter a trade, either you're going long or going short, you're selling or you're buying, it's right over there. It's not listed or injected after you enter the trade. It's already there. So it's your choice to enter at that specific rate or wait a bit if the spread gets lower. That's the general idea. We can get to it even later and talk about it further. Commodities markets, as we provide the metals, energy. Again, please go back to your entity and check whether they provide the commodities market. Each entity provides several and specific instruments. But in general, CFI provides all of these instruments to its customers. So you can also trade and enter long positions and short positions on gold, silver, platinum, and others, oil, natural gases, also coffee, cacao, sugar. That all is provided and checked with your entity. We also provide indices and stock market stocks. Talking about indices or the index itself, let's first understand the index. It is basically a basket of several stocks in a specific segment or in a specific sector. So, for example, Nasdaq is top 100 US stocks in the technology sector. Now, why do we have an index in general? Why is it provided? Not just in CFI, but in general. Why there is the world provides indices? Is the main reason is to diverse your investing strategy. So instead of me investing in a specific stock that might have a board issue or have a crisis in the company itself, it could ruin my future and ruin my investment. But for example, if I'm following a sector as a total, whether one company does bad, I have 99 companies doing great at that specific sector. So I'm following that sector. So for example, the technology sector, as you can see, the past years, how it developed and how it's getting more and more in rising prices and stability, as well as having dividends coming from that specific sector. And I won't talk just about the Nasdaq. It's general. All of these sectors are doing well. All of these indices are doing well in general. But that's the specific reason why we have indices. And we also provide other popular world indices, FTSE, Nikkei, the Japanese indice, British, UK, which is FTSE. These all are provided in CFI that you can actually trade. And also, we provide ownership on stocks. So it's not like you're entering a trade at a stock, you're using the CFD terminology, and you're entering buy and sell using lots and using agreements, as we discussed previously, and I'm going to talk about lots later on. You can actually own a stock with CFI. So it's basically you're owning a stock, you're buying a stock, not entering it as CFDs. So this is basically the indices and the stock market. We provide them and we explain why we have something called index. What does it represent? For example, the Dow Jones is the top 30 manufacturing companies. And S&P 500 is 500 plus the other companies in the US. That's basically an understanding of the indices, world indices. Now, the forex market trading sessions and volume. Trading in stocks in general, usually we wait until the market opens, the stock market when it opens, so we can trade, and when does it close. But in the FX market, we don't wait for the stock market, we wait for the central banks in a specific country to open. When they open, that's when the trades start and the liquidity gets higher and higher and the volume even increases. So we have three main sessions: Asian session, European session, and the US session. The most traded or the most with liquidity and volume, it's between London closing and the opening of New York session. So London market banks have opened. We have trading going on, high volume of trading. And then the stock market opened in London, which increases the volume and the liquidity provided. Upon closing, we have New York central banks opened. So imagine you have London session still operating, banks and stocks market, as well as going into the US central banks opening. That volume and that specific timing causes a lot of trades at that specific moment. As you go to New York closing, volume decreases, and let's say the spread becomes a bit wider and there's no much liquidity. So selling or buying between London and New York is the easiest. And sorry, the most traded pairs in the forex market is Euro USD. It is the top traded FX pair. So that's basically the timing of the sessions. And you can also check, here we have that GMT. You can check what time it opens in your specific area. In the beginning, if you remember, I said that the market 23 hours, 5 a week. The market basically doesn't close. You can trade in Asian session, you can trade in the European session, and you can trade in the US market. So you have all that time to trade whatever pairs, not stocks. Stocks opens in the specific region that it opens in. But FX pairs are traded during the day, 23 hours a day. So you can trade whenever you want, at any time, at any moment. Short selling, going into the short selling, so we can have a better understanding. I want to go with you with this diagram so no one gets lost. Take it in a general idea. Don't force it in because it's a broad and general idea. So how do we do short selling? Number one, we borrow an instrument from the broker. Number two, we sell the instrument in the market. Number three, instrument falls in price. So I'm selling, I'm entering a selling position. Whenever it falls, I'm gaining. Number four, buy back the instrument, close your position, and pay back the broker, return it to the broker. So I took it, I bet that it will fall, it fell, I gained that specific amount, that specific drop is my profit. I closed it and it's back to the broker. And I booked my profits. That's the general idea. Let's not force it into our minds that it is actually happening in this particular way, but it's a general idea to have a better understanding of short selling. Now I'm talking regarding CFDs, calculations, and profits, losses. How do we actually understand that specific drop and that specific range? How much did I gain from it, or how much did I lose from it? It would be a loss. If I'm entering a long position, I'm buying, and it dropped, that specific range is my loss. So let's understand the PIP theory. In CFD language, PIP is how we measure our drop or our gain from a specific trade. So for example, we have Euro USD, and once again, this particular number is just for example, Euro USD is not trading at this specific number. So Euro USD is trading 1.16732. PIP is the fourth number after the decimal point. For example, as per my analysis, I believe Euro USD pair will drop hard. So I'm entering short position. Whenever it falls, I'm gaining. Suddenly, something happened and it went up to 1.1675. So 2 pips. It went up by 2 pips. Understanding CFDs and the PIP theory and the PIP language, for me, I'd understand what is my loss and what is my profit from 2 pips, either up or down, without even looking at the chart itself. Because now I got the main idea. It's like the stock market, for example, a stock XYZ went up $5. You'd eventually know if you're at a loss or at a profit at specific number. So this is basically how we calculate our loss or our profit. It is the fourth number after the decimal point in all of the forex pairs. Only except the yen pairs, it is the second number. What do I mean by that? So after the decimal point, it went up by 1 pip. That's 1 pip. Not 1 point, it's 1 pip. This is the main idea of the pips. And of course, the pip theory is calculated different for gold, for silver, for the indices, for the stocks. You can always check back with your account managers and agents for any inquiries and help regarding the calculations. Here, let's just take it in a simple manner and simple way to understand just the pip theory on forex pairs. So it is the fourth number on all forex pairs except the yen pairs after the decimal point. Okay, before I get into this, let's take a quick recap. We went over CFDs. What does it mean? Contract for difference. You're basically entering a contract with a broker. Either you're entering a contract of selling or you're entering a contract of buying. Wherever you enter the trade, it is basically your zero price. Whenever it goes up from that specific entry, it's either your loss or your profit, whether you enter short or long position. That's number two. Number three, we understood what is FX pairs. What does it mean for an exchange? What do I mean by euro/USD? What is the spread between the buy and the sell, or the ask, sorry, and the bid? We understand how to calculate a specific range, or what do we call it, or what is the language that we call an increase or a decrease in a specific price, which is pip. Now we're going to enter and understand lots and contracts. In the beginning, we said we enter a contract. Okay, I'm entering a contract of what? Of lots. Lots, we have three kinds. We have standard lot, mini lot, micro lot. I'm gonna hold throughout this presentation standard lot so we can make it easier and understand the examples better. So if I'm entering a contract of a standard lot, one lot, buying euro USD. That basically means I'm buying 100,000 units worth of that currency pair. That's the general idea. So when I enter a trade with the broker, it's like I'm buying 100,000 units of that specific pair. So here we have an example, 100,000 times 1.1780, the number that we have it here as an example that Euro USD is trading at. So it's like I'm buying 117,000 worth of Euro USD, which in reality I'm not buying. I'm entering a trade that is worth 100,000. So that's the general idea regarding lots and contracts. And we have mini lot, micro lot. It is the same idea, but a lower number. So mini lot, it is like you're buying 10,000 worth of that pair, and micro lot is you're buying 1,000 units of that pair. As if you're buying that specific amount from the broker. You can, of course, go between the micro lot and the mini lot. You can buy 0.05, 0.08, and between mini lot and standard lot 0.20, 0.30, whatever you need and you want, you can do that. So we got an idea now. When entering a trade, how much are you entering? Or what is the contract size you're entering, which is standard lot, mini lot, or micro lot? Okay, so I entered a trade, Euro USD, standard lot, one lot. What happens now? If Euro USD goes by up one lot, or 1 pip, sorry, My profit is $10. Previous example, if you remember, we said the PIP is how we calculate the range from which the number took off or took down. So it is the fourth number after the decimal. So I entered one lot on Euro USD. It was 1.1655 and now 1.1656 means I'm at a profit $10. If it went down to 1.1654, I'm at a loss of $10. Why is that I'm at a loss? Because my entry is buy. So whenever it goes up, that specific range is my profit. So this is basically the main idea. Here we understood each lot or each contract size, what it defines or what does it mean. And here it's written on other instruments. So for example, I'm entering a contract of one standard lot. It is basically as if I'm buying 1,000 barrels worth of oil. If I'm entering one standard lot on gold, as if I'm buying or I'm selling 100 ounce of gold. And on the Nasdaq, which is the indices, Nasdaq 100, it is 20 times the index, and Dow Jones, it is 10 times the index. This is basically the main idea of entering a contract and how much will I benefit from entering that specific contract. Now we understood that one standard lot is basically as if I'm buying 100,000 worth of that specific FX pair. How is it that how is it possible that I'm buying that specific amount while my balance is maybe $100 only? So how is it possible? Here comes the leverage. The leverage is basically increasing, as it's written here, increasing the value of your purchase power. So each dollar you deposit in your account, and what is your account that basically when you open an account with your agent, he's going to discuss with you what leverage do you need. Is it 1 to 100, 1 to 400, 1 to 500? It will be discussed with your sales manager or account manager. So for example, let's take the highest, which is 1 to 400. Each dollar I have in my account, I have on it for $100. It will not be shown on your platform. It's not like I have 100 and I'm gonna times it by 400 and I'm gonna have 40,000 or 400,000. It's not that idea, but the idea behind it is giving me the privilege and the purchase power to enter one lot contract trade, which is equivalent of buying 100,000 worth of a specific FX pair. So that's basically what leverage does to your account. And upon opening an account, you can discuss it with your account manager, what type of account you're going to open, how is it modified. This is all can be handled with your account manager. Leverage is also a benefit in the CFDs market. So we have now three main advantages in the CFDs market. One is you can enter both ways. You either enter sell or you either enter buy. Second, the time frame is very flexible and very open. And the third amazing feature is the leverage that you can enter trades when you actually don't have that specific purchasing power to enter that trade. Now we took in all of that terminology and we understood what are CFDs, what is FX pair, how do we trade them, the timings of the sessions, and we understood how to calculate our profit or loss. Now, going into a bit of technical, let's say, analysis, this is just a general idea to just have a better understanding of how to enter the market, how to enter the market and how to exit the market with profits or with limitations of your losses. So, for example, let's take gold, for example. We have gold trading at 2000. I believe gold is going to reach new highs. I have pre-analyzed data that it will indeed reach new highs. So it went up, as you can see, I'm using the mouse on it. It went up. It went down, but it didn't make for me a lower low. Instead, it made for me a higher low. So giving me an indication that gold has potential to go higher. And I have a resistant line. If gold breaks it, my intentions is to enter buy. For example, that it will rocket and it will do so much and do new highs. So once broken, the resistant line, I've entered a buy trade. I place my stop loss under the resistant line, just in case. What does this mean? So instead of me losing all my money, I can limit, for example, my account is $1,000. I don't want to lose all the $1,000. If the market goes down on me, I want to lose just, for example, $150, $100, for example, and have the 900 left as safe. So it is very crucial and important to place stop losses. Very, very, very important. Never, ever keep a trade open. You will lose all your money. So to protect yourself. So buying, you take the profit at pre-analyzed data that, for example, it's going to go and reach new highs or new numbers that you target. You can close your position at that specific area, taking in your profits. So for example, just an example, let me give you so we can have a better understanding. Gold is trading at 2000, went up to 2050, went down to 2100, or sorry, 2020, went up and broke the resistance of 2100. Now, I suspect gold to go even higher. I enter a buy trade. One lot standard, buying it at 2100. From 2100 and it went up to 2150, my profit is $5,000. But if gold fell $10, I'm at a loss of $1,000, which is my initial deposit, and I'm going to lose everything I have. This is the general idea of it. The same exact idea is on the selling or going short trades. Similar idea. So I'm expecting gold to drop hard. If it broke a support line, I'm entering a sell and I'm positioning my stop loss above slightly the support zone. Whenever the market switches on me and trades higher, I'm gonna support myself and protect myself from losing all my deposits and have stop losses. Take profit is on pre-analyzed data, for example, a specific number. Once it hits that number, I've gained my profits. Now, the type of orders to enter a specific trade. We have two kinds. The easiest kind is the market execution. Previously, we've seen in the first couple of slides, we had the FX pairs and understanding of FX pairs. We had an example on spot buy or sell. This is very easy. It is market execution, instant buy or sell. Instant position have been or has been opened. So whether there is a news in a couple of minutes and you decide to wait for the news to come and then enter a trade, you can do that. Or you can have a pending order. Pending orders, for example, I expect gold to fall hard. but I'm not gonna sell from that area. I'm gonna wait for it to rise a bit up, and I'm gonna sell higher. So I'm gonna gain from even a better range of numbers. For example, buying, I'm not gonna buy to 2090. I'm gonna wait for it to drop to 2050, and I'm gonna buy from that specific area. So that's specifically the pending orders. And also we have two new kinds that's not introduced in the general idea of trading in the financial markets. We have buy stop and sell stop. So these apply on the previous example, which is this. For example, we have a resistant line, and I expect if it broke this resistant line, it's going to go higher. So I'm going to place my pending order above the current price. Once it breaks my support line, and once it reaches to my pending order, give me it will give me an open position. So instead of me taking it from down and not sure if it's going to break a resistance zone, I'm going to wait for it to actually break through, and then I'm going to enter the position. Or similar idea, I'm not going to enter sell unless it breaks a support zone, a solid support zone. Once it breaks, as per my analysis, that it will continue to fall. So I'm going to enter under that specific price. This is basically the idea behind buy stop and sell stop, if you want to take a picture of it of some kind. So taking all this and actually having it, let's say, on the platform or entering a trade. So let's talk about Euro USD, and I'm going to enter buy two lots. As we said in the first example, one lot standard is equivalent as if I'm buying 100,000 worth of that unit. So here for the example, I'm buying two lots. So it is 200,000 worth of euro. And Euro USD is trading at 1.1000. How do we calculate how much is it required from me to have in my balance account so I can enter two lots Euro USD? 200,000 times the pair that's it's trading at the moment gives me 220,000. What do we do is the required margin, which is 1%, times that number. I need to have in my account at least $2,200 to enter that specific trade. If I had 2,199, I won't be able to open two lots of Euro USD. I might be able to open 1.5 lots, yes, but I won't be able to open two lots. So this is the idea behind it. So for example, I still didn't deposit in my account, but I'm willing to buy two lots, three lots, one lot. I want to know how much should I deposit. I don't want to deposit so much and maybe have greed and enter more trades because I have more in my balance and then risk it all and have losses. Or I can either stick to my calculation, and to enter that specific trade, I need that amount of money in my balance. So I'm gonna deposit 2,200 to enter that specific trade. And this equation works for all the FX pairs to understand how much is required to enter that specific trade. So a quick recap again before we end our session. We understood what is CFDs. We understood how to trade CFDs. We understood the instruments used in CFD markets and FX pairs, how to calculate our range of profits or losses using the calculation by pips. How can I enter a trade, or what is the the agreement type that I can enter, which is going short or going long, and the size of it. Is it one standard lot, micro, mini? And if I'm actually gonna enter a trade, how shall I enter? And how the calculation is made. So we took some technical analysis, some quick understanding of fundamental analysis, risk management, how to prevent ourselves from losses by applying stop losses, and emotions and psychologies. It is the most important factor in all of this. Uh, Not holding your emotions and being greedy and having greed in your trades, you're gonna risk it all and you're gonna lose more than you gain. Always, always, always have targets, have stop losses, never enter a trade without confirmations, never be very, very, very strict to a specific strategy. Strategies change. There isn't a correct answer or a wrong answer in this market. Everyone has his own identity and his own thinking regarding how to trade in this market. So never stick to one thing and expect it to end up well for years to come. Market is always changing. You have to understand and go with the flow, go with the market. As it's known, trend is your friend. Never go against the trend. So there isn't something such as it's so high up, it's gonna eventually drop. That's not always true. Sometimes it is, but it's not always true. So never enter a trade without confirmations, never have over emotions, never be very, very greedy, and stick to one specific strategy. Ending my webinar, we're gonna enter into questions later on. I hope we all gained from this webinar and we understood how to trade and what is CFD markets. Any questions or inquiries, you can always reach out to us, reach out to our sales team, our agents, and even your account managers. Going into our services, we have the profits bundle. These are all of these are provided in CFI, but always, always go back and check what is exactly provided in your entity. Not all of the instruments are provided in all of the entities, so you must check with your account manager. We have lots of trading applications, and we are now on TradingView, a very, very advanced platform. We have Trade Evolution, CFI Trade App, MetaTrader 4 and 5, and CTrader. Capitalize AI, I'm going to get into it soon. Hoco Cloud, Telegram, Gate to Pay, and Trading Central, 3 webinars. So let's start and answering the questions before I get into it. Yeah, the recording you can check back also with your account managers. They would provide you with the recordings and also the presentations. If anyone has any questions, we can start to answer them. Yes, yes, of course, you can choose any platform to trade on, TradingView, MetaTrader 4 or 5, whatever suits you, whatever you feel comfortable trading on, the screen feels better to you, you can do it. The difference between what, again, between you mean the platforms? Each platform has his advantages and has his disadvantages. Like for example, personally, TradingView for me is better from looking at the charts, better to draw on the charts, better even for my eyes. MetaTrader is a bit outdated, but it's the most used platform. You can also do analysis on MetaTrader, but better for analysis, TradingView, I'd recommend it. TradingView. Futures and options are not different from CFDs. Let's understand just the terminology of CFDs. CFD stands for contracts for difference. So you're entering a contract, either buy or sell, for the difference it's having. Futures, you're entering an agreement, and options, you're entering agreement. If it falls beyond that, you get premium. It's a different type of financial market. Yes, of course, you can ask for someone to train you. You can always go back to your entity, CFI entity. They would help you to understand more of the terminology and more of lots and contract sizes and the account you're going to open and how to trade. But let me clear one thing out. CFI never, never, never gives you a direction to either buy or either sell. We just give you an overall view, entering the market either buy or sell using Trading Central as they provide us with the signals. There will be the agents, sales team, support team, account managers. They're going to help you to understand more regarding what I just explained. CFDs, I don't want to get so much into it because it's not the general idea, but it doesn't have to do with CFDs in general. CFDs, you can trade it with any broker you want, as well as futures and options. But it's not that, I don't know how to explain it to you. Uh, in CFI, we don't provide futures and options. So that's one, let us agree on it. But it is completely different strategy, completely different idea than CFDs. It's like you're telling me what is CFDs and what is stocks. That's the difference between CFDs and futures and options. I'm gonna continue with the services we provide, and I'm gonna check your questions later on. So the products we provide, as I told you, you can always check with your entity what is provided at that specific entity. We have Trade Evolution, CFI Trading App, MetaTrader 4, 5C Trader, and Trading View. We recently been on it. Also, we always release our quarterly report, daily stocks report, weekly stocks report. We talk fundamental and we talk technical analysis regarding the stocks. Again, we do not provide any straightforward signal. We never, never, ever say buy and stop or sell and stop. We always give two pre-analyzed data strategies, and it's on you, on your analysis, whether you're going to enter the buy or you're going to enter the sell strategy. These are all via Telegram. We also provide signals, news signals, fresh. Whenever they come out, we send them out on our Telegram program. So I advise you to follow us on Telegram. You can also check back on the website. It is provided over there to add CFI Telegram app. We have it in Arabic and we have in English, as well as we have other subject that we talk about in Telegram. We have Gate to Pay. It is basically a Visa that you can enjoy it and deposit, withdraw from it from directly your account. Check with it with your entity if they provide it also or not. Hoco Cloud, this is a very, very interesting feature and subject. It is basically copying someone else's trades. So what do I mean by that? For example, I'm listed on Hoco Cloud. I'm not, but for the example, I'm listed on Hoco Cloud. My profile is there. My profits are listed for the year. How much did I do for the year? And my commission is listed. So you trust Better. You believe that Better is doing so well in his trades. I'm gonna follow Better. Whatever trade I do, it will automatically open in your system as if you've done it for yourself, automatically. So this is Hoco Cloud. You can also check with your account managers how to link Hoco Cloud with your account, and you can follow whoever you want. The commission is listed over there, and you can follow whoever you want from Hoco Cloud service. Whatever trades they put, it will automatically open in your platform and in your um, application. Whether your phone is off, whether you're traveling, it's linked by the server. So an open position that's done over there, it will be directly opened in your server, in your account. And whenever he closes it, it will close with profits, hopefully, and not losses. And if there was losses and he closes it, it will reflect also on your app with your losses. You can also do any modification for his trading. For example, he opened the trade and he's gaining profits from it exceeding $1,000, for example. You're, you don't want to greed and you don't want to have losses, so you decide to close it at 1,000 profits. You can do it manually and you can close it. No worries, it is possible. Trading Central, as I said, they provide us with the signals, buy and sell. We never provide one strategy, they provide two, and it's for you to decide whether you're going to enter buy or you're going to enter selling position. Capitalize AI, very beautiful feature. It is basically as if you're giving a robot a pending order, but with a specific details or a specific strategy. For example, if gold breaks 2,100 and stays above it for 1 hour and gives a signal of trade reversal, for example, and the momentum is very high, enter for me one lot standard buy trade. When all of these rules are met, the AI will open for you a position at the moment. So if I'm gonna travel, I'm gonna be away, but I want to make sure that if it breaks and if it stays above and if, and I have set of rules or strategy, for example, I can just give it to a Capitalize AI and it will reflect on my system. Whenever these rules are met, it will directly open a position for me. Also, if you don't have any strategies in mind, Capitalize AI would give you an idea of pre-analyzed strategies and used and very well known to use if you want on your trades. Tip ranks, same idea. Trading View, as I've told you, you've recently been on that platform. Here, if you want to download the CFI trading app, as I'm gonna now check your questions. Local stocks, please check with your entity if they provide local stocks. I believe Oman, for example, they provide local stocks. Here in Kuwait, we don't provide local stocks on CFDs. CFDs is your trading contract for difference. Futures and options, you're not entering a contract, you're entering an agreement, you're buying the actual stock or you're buying the actual instrument at specific rate with a premium. If it falls off or if it at your preferred entry, you're gonna benefit or you're gonna lose. But CFDs, it's like you're entering the same idea. It's betting on futures and options, the same idea. But CFDs, contract for difference, it's either you're entering a buy or you're entering a sell with no premium. There is no premium. Like for example, if you're entering a sell and it's at a premium to buy it at that specific price. There is no premium on CFTs. You enter on lots and not premiums. There is no minimum capital. You can enter how much you want. That's up to you. No worries regarding that. I would suggest something for anyone who wants to understand more of the market and be well prepared for it. Open a demo account. Let me check the next slide. Here, you can open a demo account, and the initial deposit in that demo account, you can choose, I believe, until 1 million, 100,000, you can choose whatever you want. It's a demo account. I would suggest to choose the minimum when opening a demo account. Like, for example, I believe the minimum is $5,000 or 10,000, and use it as if it is real money. Because if you open an account, a demo account with 1 million, for example, you won't feel anything. If you're losing $500, it's nothing to you. It's a demo account, and your account has balances, and you're happy, and it wouldn't affect you. But if you minimize it to the least, or bring it close to what you're thinking that you're gonna deposit when you open a real account, it's gonna be a better understanding of entering one lot. How can it be so scary, and how it will be very effective if it falls down, for example, on gold, $2 or $3. So it's better to open a demo account with a very low balance, so it can be more realistic. Okay, guys, I thank everyone that's attended this webinar. It's indeed a pleasure. If anyone has any last questions, or you want me to explain one last slide before we end our webinar, I'd be happy to. Okay, thank you guys so much. It's indeed a pleasure to meet each one of you. Maybe there wasn't any interactions personally, but a pleasure. And I hope we all gain from this webinar, and I hope we all benefit from the market and gain profits instead of losses. All the best, guys. Anything you need, you can reach out to your agents, sales team support. We're happy to help. All the best, inshallah.
CFI. Empower yourself.